Hello, Ottawans. I'm Obaid, your real estate agent, and we have the pleasure of speaking with Andrew Thake, a seasoned mortgage broker who helps clients navigate through financing their homes. He will help us with insights to understand the mortgage processes. Welcome, Andrew, and how's it been so far?
It's good. Yeah. How's your day going?
It's going great, and thank you for being here.
Thanks for having me. I'm excited for this.
Before diving into a specific mortgage product, can you explain what a mortgage is and what are the basic components that a buyer need to be aware of?
Great question. So let's just dive into mortgages 101 for a minute. Basically, a mortgage is a loan used to buy a house. The biggest difference between that and a personal loan is that it's secured against the property. So similar to a car loan being secured against the vehicle itself. Within a mortgage, there's going to be different types of payments that you could choose from: monthly, biweekly, weekly. And within each payment, there's going to be principal and interest as a component of that. Now, some of the popular terms with mortgages, one of them is term, which is typically the amount of time you're holding a rate for, let's say a 6-month up to a 10-year fixed rate. One of the most popular options being a 5-year fixed rate. There's amortization. That's the length of time that you'll have to pay the mortgage off, typically a 25-year. There's the interest rate. Obviously, that's the interest you'll be paying on the mortgage. And those would be some of the main terms associated with mortgages.
With various mortgages available, choosing the right product can impact the borrower's financial future significantly. What are the different mortgages available for home buyers?
Well, I'm glad that you mentioned the financial future, because when you're picking a mortgage product, it's very important to line it up with your future goals and wants and needs and finances. When we're looking to mortgages, there's two main components that we typically start with. It's a fixed or a variable interest rate. One is basically just setting an interest rate for a set period of time. For example, a 5-year fixed rate mortgage. Another option would be the variable interest rate, when that interest rate is going to float up and down with the Bank of Canada announcements. And that's been pretty popular lately because the Bank of Canada has recently started to lower interest rates. So the variable interest rates have become more of a popular topic recently here. The other component within that would be open or closed mortgages. A closed mortgage is what you typically have as your standard mortgage. If someone says, I have a mortgage, it's usually a closed mortgage. But a closed mortgage does give you options to pay it off faster, making extra payments of anywhere from 10 to 20% of the original mortgage balance per year. Okay. So even though it's got words like fixed or closed, there still is flexibility within that. The other option would be an open mortgage. Open mortgages are great for people who just, at some point in time in the near future, need to pay the entire mortgage off, because that's going to allow you to do it without a penalty. However, the interest rates for open mortgages are typically higher than closed mortgages. So you wouldn't want to have an open mortgage if you didn't need it. But if you have, let's say, an inheritance coming down the road, or for some reason down the road you did need to have that flexibility, it does give you that option.
Understanding mortgage rates and conditions is key to finding a loan that suits a buyer's financial goals. How do mortgage rates and terms affect the loan, and what should borrowers consider when selecting one?
Absolutely. Great question. So borrowers need to think about what the future is going to be bringing them. Do they plan on relocating, maybe leaving the country, whether for work or for other, marriage, getting a dog, a new job? There's just so many things that can go into the road ahead, because when you're signing a mortgage contract, let's say for 5 years, that contract can come with quite big penalties if you were to break that mortgage. So you want to make sure that you don't run into a situation where you could face penalties. So if you thought, oh, well, I'm going to be relocating to a different province in 2 years, maybe you don't want to get a 5-year fixed rate mortgage, especially with a localized credit union that might not have offices or operate in that other province. So with that, you want to pick the term towards your timelines there. Potentially you've met someone and they have a home, and the goal is to move into their house. And let's say you're coming up for renewal. Again, maybe you don't want something like a 5-year fixed rate. So just seeing what the road ahead is. And sometimes that can be challenging to see the road ahead, especially if you're, at a transitional phase in life and you don't know what things are going to be like next month, let alone next year, let alone 5 years from now. So with that, having mortgage terms that are flexible can be a real win. For example, a mortgage that's movable. So a 5-year fixed rate mortgage that's portable or movable means that basically you can move it to house for the next half a decade without triggering a penalty. Some mortgages are portable with or without penalties. So that's really important to know. So when you're talking to your mortgage advisor, your mortgage broker, just make sure that you're laying down your game plan in the road ahead. And if you're not sure what that game plan is, just making sure that the mortgage product you choose has all the different flexibilities in it to make sure that you're not blindsided by penalties or extra fees.
There are various options and programs to help first-time home buyers navigate the mortgage process and makes home ownership more accessible. What are those programs, and how can first-time home buyers benefit from them?
There's a few different options that first-time homebuyers could take advantage of. One that many people don't know about is called a flex down mortgage. Now, this is all about just making sure it's the right fit for you and your finances and your goals and things like that. But a flex down mortgage basically allows you to borrow the down payment, whether it be from a line of credit, from a family member, a credit card or whatnot. So you do want to make sure that the payments that you have on that borrowed resource, though, are worked into your budget so that you're not blindsided or you don't get in over your head. But that is definitely an option there for first-time home buyers. Now, that product is kind of isolated for those with flawless credit history, so that's just something important to know. Another option would be your FHSA, your first home savings account, and that's kind of got a bit of flavor from your TFSA, your tax-free savings account, and your RSP home buyers plan. So you can put money into that account, and that's tax deductible, and you can also take money out of that account without those tax repercussions as well. You have an $8,000 contribution limit just by opening the account, so if you don't get to use it in 2024, that'll roll over into 2025 and you'll have $16,000 of contribution limit. So I recommend anyone who's thinking about buying in the next year or so, even if you're not ready right now, at least open the account so you get that contribution limit and then you'll be able to use that in the future.
All right, Andrew, let's kick things off with a hot topic, refinancing. A lot of folks hear about it, but don't really grasp how it can affect their wallets. So what is refinancing?
Refinancing in general, that's typically where you're taking your mortgage and you're doing a major change to it. And many times it could be something that's triggering a penalty. For example, if you have a higher interest rate and you want to break the mortgage and get into a lower interest rate, that could trigger a penalty. Or if you're wanting to borrow more money against your existing property. Now, there are other options, or there are options available where you can do that without triggering penalties. Some lenders have kind of a blend-in increase where you can just take your mortgage and blend the terms with the new money. Maybe you can add a line of credit on the side. That would still be considered refinancing, so borrowing more equity from the property. So basically refinancing is just making a major change to your mortgage there. And many people get that term confused with renewing, a renewal and a refinance. So renewal is just when your current terms are expiring and basically you're going to set up some new terms on that, like a new 5-year fixed rate going forward.
Speaking of refinancing, what are the potential benefits and drawbacks of refinancing?
So when looking at the advantages and drawbacks of refinancing, it's going to be a case by case, depending on what your needs are, what your goals are, the interest rate environment, penalties. There's so much that goes into that. So you definitely want to sit down with a mortgage advisor, a mortgage broker, just to work through that together. For example, if wanting to break your current mortgage contract to take advantage of upcoming lower interest rates, you want to make sure that the savings do outweigh the penalty. So that's something important to know. So one of the drawbacks with refinancing in that case would be that there's the penalty. Some of the benefits with refinancing are maybe you want to consolidate some debt, free up some cash flow, things like that. So refinancing could be a big help there. Other times when people might refinance is if they're going through a divorce or separation and they need to pay out their ex-partner, ex-spouse. That could be an area where refinancing comes in. So refinancing can cover quite a few different bases, and there's definitely pros and cons to it, but your mortgage broker will be able to kind of break down all of those just to make sure you have make the best decisions possible.
Applying for a mortgage can be daunting, but being well prepared can make the process smoother. What are the essential tips you have for first-time home buyers to prepare for a mortgage application?
Number one, you got to have a budget. And for that budget, you can talk to a mortgage broker. They can help walk you through it. There's a lot of awesome online calculators, free ones or paid ones, where you can just go through because you kind of want to know where's your money going and how much money do you have left over at the end of the day. And if there's not enough money left over at the end of the day for this possible house purchase, maybe where some of your money is going that you could help streamline that, like potentially you're going out for dinner a lot or ordering food a lot. Maybe in this new house, you want to be cooking dinner. So maybe there's some ways that you could offset those expenses. So right off the bat, creating a budget, finding out how much money is coming in and where's it all going. Next up, you just want to know overall where your finances are at, your credit history, how much money you're making, your type of employment. Because when you meet with a mortgage broker, these are questions that they're going to be going through with you. Are you contract? Are you term? Are you occasional? Are you salaried? Are you on probation? So just knowing a little bit about what your type of employment is very important. And if you're not quite sure, getting a letter of employment, basically a letter from your employer, it usually will break down all the details of your employment that your mortgage broker or bank's looking for, and that'll give them some good guidance. Now, as far as the documents needed or what's involved in the application, definitely just picking up the phone and talking to your mortgage expert. They're going to help guide you through all of that. And mortgages do come with quite a few documents, so definitely having someone walk you through that can be of great value.
Emergency funds, it's not the hottest topic, but it is crucial. How can have an emergency fund help homeowners avoid pitfalls?
Setting aside 3 to 6 months of monthly income is sort of the recommended amount to have tucked aside there in an account, because you never know what's going to come up. An unexpected vet bill, maybe an incident at work, you break your leg, you go on long-term disability, and there's a little lag before the disability kicks in. There's so many things that can just come out of nowhere, and that's the word emergency. So having those funds available for that
Yes.
is crucial.
Yes.
There's a stat that I was reading recently that said about a $500 to $1,000 expense can set the average Canadian set their finances off. And especially if you feel like you're living paycheck to paycheck, or maybe home-wise, you bought a bit above your means, you want to make sure that you're protected there. You've worked so hard to get that house, from saving up the down payment to advancing in your career to have the income for that, to making sure you've got great credit history, to the closing costs, to all of that stuff. And you just want to make sure that you're protected within that. You've worked so hard to get there, so you might as well have that little nest egg saved just for those what ifs.
Here's something not a lot of people think about: viewing your home as an investment. How can treating your home as part of your long-term financial strategy makes a difference?
Looking at your home as an investment, you've really got to look at it as this is an appreciating asset. And if we look at the short term, let's say 6 months, you want to flip the home. Yes, will it go up or value or down in the next 6 months to a year is one thing. But most people, when they're buying a home, they're buying it for the long run.
Mhm.
They want to, raise a family there. They want to live there, and they want to get a dog or something like that. They're going to be there for the next, half a decade, multiple decades. So with that, it's a very strong investment in the idea that, let's say on average, real estate appreciates 5%. Let's just use that as an example. Well, if you put $25,000 down on a $500,000 home, yes, that asset now, that $500,000 asset is growing at 5% per year, for example. And although let's compare that to another investment, let's say you put $25,000 in the stock market and you could get a 10% return. Well, it's just that $25,000 that is gaining that 10% return, as opposed to the $500,000 asset gaining that 5% return. So you're going to see a bit of an amplified effect on the investment into real estate.
The snowball effect, we're talking about small, consistent investment growing to something bigger. How does starting small with real estate can lead to significant returns?
Yeah, that's a really important thing that you've mentioned about the snowball effect. And the reason is because, when I meet people to buy their first home, a lot of them want to have, that $1 million home in the desirable neighborhood with the 3-car garage and the big yard. And so many people desire that. But it's hard to start there, especially with house prices where they are these days, and incomes. Through the pandemic, house prices were growing so fast, and income wasn't sadly growing at the same pace. That would be nice. So with that, people are not getting potentially to the pre-approval purchase price that they want. So right now, it's just all about getting your foot in the door, getting something that starter home, going back to the starter home. And yes, you might look at this and say, this isn't the forever home, but just getting in there and thinking, okay, well, I could be here for a year. I could be here for 2 years.
Yes.
Let the place appreciate in value a bit, pay down the mortgage a bit. Or in the meanwhile, if it's a smaller place than you originally set out for financially, maybe you've got a bit of extra funds set aside, so you could be saving up to add to that for the down payment on the next place. So with that, just getting your foot in the door, building up a bit of equity, that's going to be your playing card to play for that next home and the next home, and sort of making that so that in the long run, you can eventually get to that ultimate home in your dreams with that desirable neighborhood.
Mortgage rates are always a hot topic. They've been dropping consecutively for the past 3 announcements. How do these dropping rates affect home buyers' mortgage decisions?
Great question, and very hot topic, interest rates. I mean, always a hot topic, but extra hot right now, especially now that the Bank of Canada in June started to drop interest rates. They've had 3 drops now, with more supposedly to come, which will be fantastic and give a lot of relief to those variable interest rate holders. We've seen them come down by 0.75. Variable interest rates as a whole are still quite a bit higher than fixed interest rates, but fixed interest rates have been dropping for quite some time now, we'll say since New Year's, just for fun. So as rates go down, purchase power goes up, because when we're looking at your application, the lower the rate, the more you qualify for. But also when we have something called a stress test in Canada, which is basically taking the interest rate that you'll have on your contract, the interest rate you actually have, plus 2%. So when we look at that, let's say interest rates are at 4% right now. Well, 4 plus 2 is 6. That's going to be a lot easier to qualify it than, let's say, 6.5 plus 2, 8.5. So that's definitely going to amplify people's purchase power. So anyone who got pre-approved last year and maybe just wasn't getting to the purchase price that they were hoping for, it's a great time to have a new look at that with interest rates declining. For those who want a variable interest rate in general, they don't want to go with fixed. The lower the rate, the better, obviously. And again, as I was saying, those who currently have a variable interest rate are going to start to see some payment relief now that's dropping, because a lot of them had quite a pinch through the rising interest rate environment.
Let's talk about variable versus fixed mortgages. In a market that's constantly changing, what do buyers need to know about those options?
Well, fixed rates generally are the most popular option. And within that, a 5-year fixed rate, I sort of parallel that to the four-door sedan of the vehicle world, one of the most popular, if not the most popular vehicle on the road. So, the fixed rates are definitely that staple. A lot of first-time home buyers like fixed interest rates because the payment's the same, it's predictable, it's easy to budget. And although we are entering a lower or declining interest rate environment, many are still just going with that tried and true fixed rate. Variable interest rates, on the other hand, yes, you could take advantage of potential future interest rate drops. The challenge is that the variable interest rates are so much higher right now, and they have come down by 0.75, but they do have a ways to go because they are sitting about 1% to 1.5% above fixed rates right now, which from an application point of view can eat into quite a bit of your pre-approval purchase power. And from a money out of your wallet point of view, that can amplify or make your payment quite a bit bigger. So there's definitely pros and cons to both. And I think it's just a matter of, sitting down with your mortgage broker and kind of going through those and going through the different payments for the different options and where the interest rate outlooks are and just trying to find the best fit for you.
For those looking to buy their first home in Ottawa, there is a simple math equation, a person, for example, watching us now, sitting in their living room, that they can do just to have a general idea how much they can qualify for?
Got this kind of, it's not 100% accurate, but it's definitely going to give people an example of where they might land purchase price wise. So let's do this together.
Viewers, be advised, this is not accurate. This is just a general equation to have a general idea. So when you go and actually apply, you might not get the same amount, but the math equation is.
Absolutely. And this is just assuming you have the minimum down and a small amount of debt, we'll say, is worked into this. But it definitely changes person to person based on your debts, your credit score, and so much more, your type of employment. So let's just say you're sitting on the couch and you're scrolling through properties online. You think, oh, I wonder what that would cost me per month. So here's a quick equation. So just grab your household annual income, your gross annual income. So let's just for fun say that's, amongst two people, 180,000. Now each is going to have their own, of course, with that. But just for an example, we'll divide that by 12. So you get $15,000.
15,000, yes.
So you times that by 0.33.
Time that by 0.33.
What do you get there?
$4,950.
You got it, $4,950. Now times that by the secret sauce. Times that by 150.
150.
And what do you get?
$742,500.
So there you go. So a household annual income, a gross annual income of 180,000 with a minimum down and just sort of a smaller amount of debt is probably going to get to a home price of around 740,000 based on current interest rates. Now, as interest rates go up and down, these numbers could change, and there's so many other factors. But that's just your quick and simple. If I needed a $50,000 buffer where I'd land, that's just going to give you an idea.
So basically, if you're looking to a property that's more expensive than $742,000 and your household gross income is 180,000, the difference of price is something that you have to pay. And then you can actually qualify for that property.
Yeah, so let's say that you did an actual mortgage pre-approval and it landed at 740,000 on the dot there officially, and you wanted an $800,000 place. Now that was just with the minimum down, so you could always offset that with putting more money down. For example, so in that case, you'd be off by the $60,000. So if you had $60,000, maybe from a family gift or from your own resources, you could help boost that to get to a bigger purchase price.
Co-signers, superheroes for the saving. Adding them on the application can be a great benefit for people applying for houses that they cannot really qualify for. What should people know about adding a co-signer, and what are the potential pros and cons of having a co-signer on your application?
I like that, the superheroes and almost the ones in the shadows like the Dark Knight. And the reason I say that is because, so many people when we're crunching the numbers for the application say, I don't get it. My colleague qualified for more. My friends are qualifying for more. They make the same amount of money as me, or they make less. And that hidden secret is either a co-signer or gifted down from family. The bank of mom and dad, popular saying these days. So that is something that we're seeing more and more often, are the co-signers being added to applications.
How does having a cosigner impact your mortgage application?
So the cosigner generally adds value to the application, and value, I mean, just getting you to that higher price point if you're just not qualifying for what you're looking for, because now we're taking your income and adding their income, almost like a partner or spouse, right into the application. However, we're also adding their debts against if you have any debts there. So if the cosigner, has a cottage mortgage and their own mortgage and a car loan and an ATV loan or something like that, they might actually pull back on your application. Potentially they've got enough going on their own. But a lot of time, people are seeking help from their parents, and maybe their parents have good stable income or a stable pension. And a lot of people say, oh, they might not work because they have a pension, but a pension is great because it is that great, stable, consistent, confirmable income. So pension's fantastic. And many times that generation is going to have lower debt or no debt, maybe they're mortgage free. So many times adding that cosigner can be a huge help. And I know it can be a difficult question to ask. We always want to blaze the trail on our own and have that pride of being able to do things on our own. But looking back, let's say 5 years, if your house has gone up in value, your mortgage has been paid down, you've got $100,000 in equity or something, just for an example. It's a question well asked to see if they could cosign.
What are the pros and cons of adding a cosigner?
The pros and cons, on your side, the pro is maybe you'll qualify for the home price that you desire.
Yes.
The con is that, if you are buying sort of above your means, then you've got to make sure that you're comfortable with that mortgage payment. So when you're adding a cosigner, you always want to make sure you've got your budget down pat so you don't buy beyond your means or go into that sort of house poor feeling that some people can have there. So that's one of the kind of pros and cons there. The other one is for the cosigners themselves, because that debt obligation from the mortgage payment to heating to property taxes, all of that would have to go into their application. So let's say someone cosigning feels like, we want to retire and buy another property, or we want to buy an investment property, we want to buy a cottage. Your mortgage payment and all of your mortgage particulars and house particulars have to go into their application. So that could stop them from being able to buy something if they don't qualify for that anymore. So when you're looking to add a cosigner, you also want to just see, what do they have on their horizon? Because if it blocks them from achieving their goals, you just want to know that up front, so there's no conflict down the road.
If there's a cosigner on an application and then suddenly they decide that they want to buy their own property, but being a cosigner on the application is preventing them from doing so, what are the exit strategies that they can have to exit from being a cosigner and buy their own property?
Perfect question. So with that, the two main strategies would be that many people follow are just, they'll revisit at the end of their term. So let's say they took a 5-year fixed rate mortgage. At the end of the 5 years, they'll just say, hey, we were thinking about taking the cosigner off. There's usually some legal fees associated with removing a cosigner, so that's important to know so you're not blindsided there. But the other time, or probably the general idea of when can I remove a cosigner in general. So the safest answer to when you can remove a cosigner is as soon as you're financially able to take it over on your own. So some people set out saying, well, I only want the cosigner for 3 years, but maybe you lose your job or you go on disability or you don't end up getting that pay raise or you don't end up paying down debts or building your credit score, whatever was in the way the first time around from you qualifying on your own. So if that doesn't get fixed up by the time that cosigner wants to be removed and move on, it just might not work. They might need to stay on. So that's really important there. So as soon as you're financially able to take it over on your own, you could always revisit your bank or talk to your mortgage broker about having that person removed, or just revisit it if the cosigner has no other plans in the immediate future, just revisit it at your mortgage renewal.
Student loans and mortgages, what's the connection? And how does student loan repayment affect the eligibility of being qualified for a mortgage?
Student loan is added into the application. It's added into the liabilities as a debt, no different than a car payment. Now, when we're looking at student loans, there's two types of payments that we typically would see. If your student loan's gone into repayment or if it hasn't. And actually, if your student loan has gone into repayment, sometimes the payment might be a bit higher than if you were only paying interest only or there was payment relief or something like that. But from the mortgage application, that can be a big help because if the student loan hasn't gone into repayment, many lenders will use, let's say, 2 or 3% of the outstanding balance as a payment, which can be substantially higher than what your repayment is.
Okay.
So let's just say, for example, that's $400, but your actual repayment is only $80 or $120. So it's much more favorable to have that lower payment in the application to help with your purchase power. Another thing to consider with a student loan is, let's say you're putting down $50,000, $20K more than the minimum down, but you have a $10,000 student loan. You could just see about taking $10,000 from your $50K down payment and paying off the student loan. And you still have a decent sized down payment. You still have your 40 grand down, but you don't have any student loan payment anymore. So yes, your mortgage payment's gone up by a little bit, but you won't have that other debt to really worry about. And having really one debt obligation versus two is more beneficial for many people.
Yes. Looking ahead, what's the upcoming scope for the real estate market for the upcoming years? Are we expecting a hot market? Should investors and buyers expect big changes in the market?
Well, we power of positive thinking. Everything will be smooth sailing in the road ahead. We've definitely seen some turbulent times over the last few years here. Now, with that, there's definitely a general theme that interest rates are going to continue going down. And with that, there's a general track record that when interest rates go down, supply and demand, there's more demand on homes, home prices go up. So with that, we could potentially see home prices grow in the future. There's also some government changes taking place, like 30-year amortizations, smaller down payments on properties over $1 million. So there's some changes like that can come as well, which will help, stimulate the market, which then again, supply and demand could raise house prices. So anyone who's thinking about getting into real estate, whether you're thinking now or a year down the road, it's probably just a good idea to crunch the numbers, see what's possible, because if that dream home does come up and house prices do happen to climb, if you can kind of stay ahead of that curve, that would be great.
Inflation is always in the news and affects so many things. How does it play a role when it comes to mortgages? And what should buyers and homeowners understand about this relationship?
Inflation, obviously a hot topic coming out of the pandemic. We saw inflation, big inflation numbers. We've all felt it at the grocery store, for example. So with that as well, we've seen interest rates increase, especially on the variable interest rate side, with the Bank of Canada needing to raise interest rates. So now we're starting to see a reverse trend. Inflation numbers are getting more favorable. Interest rates are starting to come back down, and there's talk that that'll keep going. So when interest rates go up, typically we see house prices go down. When interest rates drop, we typically see house prices go up. So that's a relation rate there. Also, lower interest rates mean less money going towards interest of your mortgage payments, smaller mortgage payments, things like that can really help buyers. So hopefully, we'll see some more favorable inflation numbers continue here. Interest rates continue to drop just so that buyers have just more relief or more favorable payments, especially those who currently hold a variable interest rate. I know a lot of them have been rooting for these drops for quite a while because they've been feeling the constraint of those rising interest rates for the time there.
There are changes coming to the real estate market, which is the 30 years amortization period, and a lot of people are viewing it to be too long of a period to be in debt. What are the mortgage hacks that people can apply to decrease that period of time?
So I'll break that down into two parts. The 30 year, you were just saying that some people are feeling like that's too long. Fortunately, you control your amortization. You can't pay your mortgage off slower without facing penalties, but you can always pay your mortgage off faster. And with some lenders, you can pay your mortgage off in as little as 5 years, give or take, without any penalty whatsoever if you're taking advantage of your prepayment privileges. Now, that's a lot of money. If we all could pay our mortgages off in 5 years, that would be wonderful. But fortunately, you could just think of it as a starting point, a way to get your mortgage payment a bit smaller from the start, and then you could bump the payment up down the road, again, with the flexibility that lenders give you to either do the lump sum contributions or increase your payment. Now, part two is what are some hacks to pay your mortgage off faster? So right off the bat, a simple hack is just signing up, switching your payment to biweekly accelerated. There's biweekly regular and biweekly accelerated. Those would be your two main types of biweekly. Now, some only do accelerated and some only do regular. So that's something important to know when you're choosing a lender there if you were interested in the accelerated option.
Okay.
But the accelerated option basically takes the regular biweekly payment, makes it a bit bigger, which helps you make extra payments on your mortgage to pay your mortgage off faster. And that's going to help you shave a few years off your mortgage. Absolutely. Some other ideas would be, once the dust settles and you've moved in, your first mortgage payment, if going monthly, usually doesn't come out for a month after your closing date. So if you were able to make that first mortgage payment right after closing, if you had some resources available, that's just going to go directly on the principal, and it's going to amplify because that's just 25, 30 years less interest accumulating on that one payment. So every dollar up front in your mortgage does go a long way down the road. Another idea would be to take your monthly payment divided by 12 and then add that amount to each monthly payment. That extra amount is going to go directly on the principal and is going to basically equal one extra mortgage payment per year onto your principal. So those little things can go a long way. It might not seem like a big deal throwing a couple extra $100 on this 25 or 30 year thing, but it really adds up over time and can save you tens of thousands of dollars in interest with some of these options.
Different type of buyers face different type of difficulties when applying for their mortgages. What type of difficulties do different type of buyers face when they apply to buy a property?
First-time home buyers, one of the biggest challenges I see there is just affordability. They come to the table wanting, let's say, $700,000 or $800,000 property and maybe not being able to qualify for that much. So then opening up the conversation about a gifted down or putting more money down or adding a cosigner or just bringing them into more of a price range that matches their current income. So that's one big challenge that I would say first-time home buyers are facing, especially with the rising, prices of homes just continuing to go up.
What about investors buying their investment property? What difficulties do they face when they are applying for a mortgage?
The minimum down on an investment property is 20% down. A lot of people just don't have that in the old savings account. So for that, many want to tap into the equity of their existing property. But those who bought maybe during the pandemic and then have seen prices flatten a little bit, they might not have as much equity as they were hoping for, as they thought. At this current time. So when you're looking to borrow money from your existing property, you can basically borrow up to 80% of the current value, and then you can use that towards the down payment on your next place. Or if there's enough equity, you could use it to just cover the whole next place. Let's say it was a small condo or something like that. Now, people aren't sure about how much equity they have in their property. A quick little calculation is just whatever you think your property is worth these days, times that by 0.8, and then subtract your mortgage amount. So let's say you have a $500,000 property, times that by 0.8, and if you had a $200,000 mortgage, so minus $200,000, that's how much equity you'd have for the down payment on an investment property, for example.
Okay.
Now, if you didn't have any savings, you have to make sure that that's at least 20% down, plus the closing costs like legal fees, land transfer tax for that next property. So those are some numbers that you'd need to know, sort of going into the appointment or
Yes.
the mortgage appointment there to see if you qualify.
Buyers looking to buy their second home or a recreational property. How is it different than buying their residential first-time home buyers?
If anyone wanted to borrow the down payment from their property for one of those properties as well, same idea. They just have to be conscious of how much equity is available. Next up is they do have to qualify for that next property, all the same as the first. Now, many people think that it's a minimum of 20% down on a second property. Let's say you want to go buy a cottage or something like that. So fortunately, you can buy a second home, a cottage with less than 20% down, and not a lot of people know that.
So it's actually easier to buy a recreational or a second property than to have an investment property. Those who are looking to start growing their wealth, they want to invest. What's the best way to start building it?
Probably one of the best places to get started is you've got to get control of your income, whether that's from your job, from your side hustle. If all your income is going towards a student loan payment, a car payment, basically you're giving all your money away to other people or helping other people make money by paying interest and stuff like that on those loans, you're never going to have that money available to invest. So you can take advantage of things like the debt snowball method or whatever it may be to help you get rid of your debt. Once you get rid of your debt, that income is your driving force towards saving for income producing assets, getting into whatever your investment vehicle is, stocks, mutual funds, finding the right fit there. So once you have control of your income, you can really start to get that income put to use for you.
A lot of people believe that they cannot tap into the real estate market, and that percentage is growing. What tips do you have for people to start planning to buy their first property?
One of the biggest things is you have to start early. Some people call me and say, hey, Andrew, I'm not thinking about buying for the next year or two. Is it too early? And I say, no, if only everybody could get in touch with me this early, because let's say it's just not the right fit right now, whether you've got too much debt, your credit score, you don't have enough income. Well, we've got, a year and a half or 2 years to get that all laid out. So if you were to write on a calendar a year and a half from now, home buying dates, as this vision out there, being able to break that down per month or per day or per quarter, whatever it may be, to get to that now is fantastic. So if it's a debt relief strategy, if it's asking your boss for a raise strategy, if it's picking up a second job strategy, or improving your credit score, it's a lot easier to have more time to navigate through that than someone who says, I want to buy a house in a month or two. There's just not a lot of time to do any kind of action plans or strategies with that.
A lot of buyers or people who are thinking of buying mainly focus on the interest rate. It's dropping, and they always have that one question in mind, which is now a good time to buy a house? So how do you answer that question?
Is now a good time to buy a house? So when you're looking at real estate as a place that you're going to move into this house, maybe grow a family or cook dinners or host socials or whatever it may be, the idea of is now a good time. There's really no wrong time. If you find the house and you're financially able to qualify for it, that's the right time, because you have to look at real estate as this long-term thing. It's not like flipping a stock, like day trading, where you're not flipping the home and trying to sell it in 4 months or 6 months. And then if that was the case, our value's going up and down. What's the short-term look like? But if your horizon is to be in this house for another 5 or 10 years, well, most likely property is going to go up in value. If we look at real estate values, 10 years ago, and then we look at values 10 years from now, it'll probably go up 10 years from now, just like it was quite a bit lower 10 years ago.
Yeah.
So with that, I think people trying to time the market, that's tricky, especially when it's such a long-term strategy. If someone said, I want to buy a stock and I want to hold it for 25 years, when's the best time to buy? Just buy it now.
Just buy now,
exactly.
Yeah.
So the right timing is whenever it's the right fit for you financially.
Andrew, thank you very much for your time, and thank you for this valuable information. If you have a set of tips for a person who's in their early 20s, just started their career, and they're thinking of buying a home, what advice would you give for them?
So one of the biggest things I would say is there's a saying, kind of begin with the end in mind. So figure out, what that possible home price looks like. Pretend you were buying it now. What is that down payment you need? Where do your finances need to be? Where does your credit score need to be? And really just work backwards from there. If you know that you need $30,000, then you know how much money you're basically gonna have to save per day, per month, per year to get to that goal. So another thing to be conscious of is your credit score, just making sure that you're maintaining a good credit score or building a credit score. So not, maxing out debts, not letting payments fall by the wayside or something going into collections. So having an excellent credit score, building that nest egg for the down payment, those are huge starting points.
Yeah. Thank you very much, Andrew.
You're welcome. Thanks for having me.
It was really a pleasure having you.
It was a pleasure.
Okay.